Okay, so the Apple financial model is now complete down to EBIT. We've finished revenues and expenses, working capital, fixed assets. It's now time to put debt and equity into the model. Now, for the purpose of this exercise, Apple has a truckload of different instruments. They've got like commercial paper, senior debt. They've got all types of different tenures. For the purpose of this exercise, we're going to focus on modelling senior debt and ordinary equity, which are the two extremes of the capital spectrum. They're pretty different in some regards, but the real similarity when it comes to modelling them is that they both have, as you can see on my screen, a return on capital and a return of capital. Now, the return of capital is obviously when you actually pay back the debt or you buy back shares. The return on capital is interest for debt, whereas it's dividends for ordinary equity. And this is an important factor because as we'll discuss in this session, interest is an operating expense of the business because the financial statements are from the perspective of the owners, of the shareholders, whereas the actual dividends are effectively coming out of retained profits. They're not part of profits themselves. They come out of profits because they're effectively returns on capital back to the actual shareholder of the business. So when you actually model these parts of the business, when you do capital structure analysis, doesn't matter whether you're modeling preference shares, convertible notes, or just straight up debt, you can use this approach of modeling its return of capital and return on capital to make it a lot easier to understand the financial statement impacts and how the balance sheet balances, etc. Okay, so let's start with debt. Now, debt basically is money raised by a business, often to finance working capital or capital expenditure, which is repaid within an agreed time frame and incurs interest expense. Okay, so the debt's obviously normally the cheapest form of finance because it's secured against the assets of the business. Normally, that's when it's called secured. And it's normally issued based on a term sheet. The term sheet just says basically, if you don't achieve certain good targets, we're going to force you into insolvency, or we're going to claw back more equity, or we're going to force you to pay back some of the debt. Okay, so basically with debt, the return of capital is paying back the debt as a business, and the return on capital is the interest. Now, to look at this, the way you actually want to model is you want to model those two things separately, which is what we're going to do today. So let's start with looking at debt balances. So Apple's debt balances, you can see them in the balance sheet. And again, this is a real simplification. If you actually dive into the notes in the Form 10K, there's a lot of different facilities in there. And it's quite interesting stuff, actually, because Apple's actually got debt, even though they have like billions. They've got like hundreds of billions of cash. They've got a couple hundred billion of cash. But they've still got debt because obviously they're actually able to earn more on their debt than they pay for their cash. So they're a business that actually makes more from their cash on their interest than they do from their debt. So they've done it for tax reasons and for complex structuring reasons. It's kind of weird that they wouldn't just pay it back, but that's all comes down to capital structure optimization. It's complex stuff. Getting money out of businesses is quite hard with tax purposes, which is why we'll see here Apple's been buying back a lot of stock. Up until their market cap soared last year. So you look at the debt balances. They're basically on the balance sheet now. Now, the debt balances for Apple are in their current and non-current liabilities. For the purposes of our model, we're going to put them all as non-current. Splitting them out really isn't complicated. It's just you've got to make a call as to what debt is repayable within 1 year. Mm-hmm. So if it's repayable within 1 year, it's classified as a current liability. If it's not repayable for more than a year, then it's non-current. So you'll see here they've got current debt of commercial paper of about 5 billion, term debt of about 9 billion, and then they have non-current term debt of 99 billion. Right, about 99 billion. So we're just gonna roll all of those up into one figure, okay, for the purpose of this model. So I think so we've got 98. So we've got 112. I think we've got 112 total, mm-hmm. right, at the end of FY20, and we're going to roll them all together. Okay, so let's go into our opening balance sheet in the model, and let's include as debt in J25. Let's include the 112,436.
J25.
J25 112,436.
Perfect.
And you'll see because we've got our retained profits balancing plug, and we don't have all our other assets and liabilities in there yet, it's resulted in our retained profits flying negative down below. We've got negative 59 billion retained profits. That's right, we'll get to that. We haven't got equity in there, for example, yet, let alone other assets and stuff. So it's mainly equity, obviously, because it's the plug. So you see here now, that's obviously gone through the balance sheet. The opening balance sheet's balancing because that's got the plug, but the actual financial statements aren't balancing, and that's because we now have a debt balance on our opening balance sheet. We don't have debt balances going through the financials. Now, if you go to the forecast sheet in the model, the forecast assumptions, you can see the debt drawdowns and repayments. Just on a terminology front, we've referred to effectively taking money from the bank and raising money as a drawdown. Repayments are obviously repaying the money. So drawdowns and repayments, you can see we've forecast. It's quite interesting. So And in this annual report, which we'll get to with equity, Apple was repurchasing billions of dollars worth of stock because their share price was a lot lower during this year than it is now. It was literally like around $70 or $80, and now it's twice that. Well, it was. It's moving everywhere. By the time we watch this, it could be anywhere. But they were buying back, which looked expensive, but in hindsight was quite cheap. So a lot of that's why they don't have, it's weird. The reason why they've got debt is quite a complex discussion. But for the purpose of this exercise, what we just want to understand is how to model debt. With a normal business, you wouldn't have these strange idiosyncrasies of enormous amounts of cash, no need for debt. Most businesses have debt and they need it to survive. They need it when they buy assets. Like you don't go and buy a new factory and not use debt. But Apple could. They've got so much cash, it's almost insane. So here, they're forecasting a drawdown of, we're forecasting at the moment, we'll just put some numbers in to make it work because you could forecast anything. We're forecast $1 billion being drawn down in 2001, which could be a refinance, along with $4 billion of repayments. So a net repayment of $3 billion. And then we put increasing, then we've just got repayments. We just said, because we're pumping cash. And I'll explain that when we get to our dividend situation with this model, because this is where modelling Apple is really interesting, the capital structure stuff. But we're forecast basically increasing to $7 billion a year of repayments. Now for FY21, that will result in Apple's forecast debt balance reducing on a net basis by $3 billion, which will take it from the 112,436 down to 109,436. Now notice that increasing your debt position doesn't directly impact the income statement. The income statement, obviously, it would potentially, we might have interest on cash. That might change a little bit, which we haven't got in the model yet. We haven't got to that yet. But the interest on cash might indirectly affect it, but mainly interest expense is what comes through the income statement, which we model as a next step. So when we do debt, we're currently focusing on the debt balances, which is the returns of capital, not
yes,
of. Okay, so here we have our net drawdowns repayments. They're financing cash flows in the cash flow statement because they're not part of the operations of the business. They used to fund the operation, but they're financing. They're funding, and then the net change, the net drawdowns, effectively, if you want to use, for one of a better phrase, results in that. That's a movement on the balance sheet. So the balance sheet is going to have a $3 billion decrease in our forecast during 21, and that's a result of drawing down 1 and repaying 3. Okay, so let's go and put this through. First of all, let's put our drawdowns and repayments through the cash flow statement.
Okay.
So let's go and let's go to the cash flow statement and go to in column B in row 32. So B32, let's put debt drawdowns. These are the first items in the financing cash flows because we're now doing capital structure stuff. Debt drawdowns in B32 and debt repayments in B33. Okay, so let's put the debt drawdown forecast in. Let's go to J32 and just do equals and go to the forecast assumptions. Put equals forecast J27, which is the drawdown assumption. You can see the drawdowns and repayments are both positive numbers. So for the repayment in J33, we're going to do equals negative forecast J28.
Yep.
And that's going to give us the negative number. As our cash flow statement, we want positives, negatives. And now we just need to actually include that in the total investing cash flows, the net cash flows from investing activities. Financing, sorry.
Yep.
In 38, just do equals sum 32 to 30, J32 to J33.
Easy.
That across, and our balance sheet's still not balanced. So our balance sheet's still not balanced because obviously we now have the actual cash flow statement impacts of debt, but we don't have the closing balances on the balance sheet. Okay, so let's go to the balance sheet. And in the balance sheet, debt is obviously a non-current liability. We're assuming it's all non-current, as I said. In some of our more complex content on our website, we do have it split, which what you have to do to split it really is, it's funny because you either need to make decisions based on exactly when the actual repayment dates are of different facilities, or if it's say a monthly model and you forecast repayments, you can actually calculate what's current at the end of the period by looking at what repayments are due within the next 12 months. So in this case, we're just assuming it's all non-current. So let's go to the debt and let's go to row 33. And in B33, let's just put debt as our non-current liabilities. And then for this formula, it's quite a simple one. We're just going to say it's the prior period balance plus drawdowns minus repayments. Okay, now we have the net drawdowns and repayments by just summing the drawdowns and repayments on the cash flow statement. The hard thing here, the fiddly thing is the prior period again needs to come from the opening balance sheet in the first period. So as usual, we're going to do equals if the period number J$7 equals 1, then take the opening balance sheet debt amount, which is that
112,436.
Exactly. Take that, and you might want to lock the column on that.
Done.
$J25. Otherwise, just I33, which is the price sell.
It's price sell.
I33. Okay. Minus otherwise I43. Now we need to do plus, and we're just going to do sum open brackets, and we're going to sum the drawdowns and repayments for that period.
Perfect.
There. Cool.
Got that one.
That's it, and press enter. And you'll see that should take you to, was that
109,436. So down that 3,000 or 3 billion.
Yep, 109,436 down by the 3.
Yep.
And it's decreasing down to 9. As you said, 90,436 down towards the end. So we just need to make sure you're including that in total non-current liabilities by going to row 35. It's doing equals 33. And our balance sheet's balanced again.
Cool. So that's all the return on capital or of capital?
That's return
capital.
Of capital.
Of capital.
And this is what's really interesting. So when most people model debt, they get really confused about the fact that you've got, if you think about how it impacts the financials, you've got interest expense, interest paid, interest payable, debt drawdowns, debt repayments, debt at the end. You end up in this real mess of what balances with what. The best way to always think about it is what is my impacts from the debt balances, which are the returns of capital. And then as a second step, you model the interest expense effectively as an interest expense item with a payable, which we're going to do in a moment. And that effectively breaks them to two separate tier accounts. And that's where if you're modeling this outside the financial statements, you would put an error check on both those tier accounts to make sure they balance. We're going to do the second part now, which is the interest expense. But it means you can modularize your, even further than what we're doing, instead of saying, look at debt as a module, you think about the subset components of debt. And that's how the financial statement has to balance. So when you look at your debt movement on the balance sheet, you need to sit there and think, oh, it's increased by X this year. My balance sheet is not balancing because of this. Let's just check that that's gone through the cash flow. And it probably hasn't, or you've got your signage wrong. So that's how you model debt balances.
Perfect.
So let's move on to the interest expense. Now, interest expense, it's an interesting one here because Apple is an unusual business in that it basically contains so much cash that as I said, it actually earns more interest on its cash than it pays on its debt. And it's such a weird business. So if you look here to get to the interest income expense, what they've done on their income statement is they've mashed it all into one line. And they've done that. So for most businesses, if you're a normal business and you say had leverage of say 60% debt because you had factories and all sorts of stuff, your interest expense would be a fairly serious expense, and you wouldn't be carrying stupid amounts of cash because it's a waste of money. Apple's just such a cash cow, such an amazing business that they don't know what to do with all the cash. So on their income statement, they just put their net interest income expense. So if you look at their other income expenses in their income statement, and then you break that down further, you can see that their other income expenses predominantly income for 2020 of almost $4 billion of interest and dividend income, followed by interest expense of less than that, which is on their, say, around $112 billion worth of debt. So their total income, then they've got here other income expense net, which is like a mere $87 million, which is actually for them almost a rounding error.
Yes.
It's so small. So basically, to get their interest expense, you can't see it on the P&L. You need to dive into the notes.
So they're working like a bank.
Exactly. And I'm sure there's tax reasons for it as well. So here, this is where it gets interesting. So if you wanted to work out what Apple's actual effective interest rate was, so the effective interest rate is basically when you're saying, I don't know what their actual interest rates are, so I'm just going to look at what their interest expense is, divided by their total debt and get a balance. Now, if you wanted to ask me to calculate Apple's effective rate, the other issue you've got is you don't know when they're repaying debt and drawing it down. It could all be at the start of the period, it could be at the end. So normally I would take the average, and I'd say let's take the average debt balance for the last year, look at their interest expense, and that gives you an interest. That gives you a position. What we've done here is we've just said, listen, if you take their closing debt of 112,436 for FY20, and you say, okay, they had their 2,873, you can just take an all-in weighted average interest rate based on that on closing debt of 2.56. And I thought to myself, why is that so high? Because the interest rates weren't quite as low then, and on top of that, a lot of their debt facilities are longer-term facilities they signed prior to interest rates being hacked down to almost zero by the government. So they are carrying some decent facilities, which I'm sure they don't care too much about because it's tax deductible, but I'm sure they'll be winding down that rate. So that's a basic indication of their overall cost of debt. But I think when we did the numbers on this, their overall cost of debt, that was 2.56. The prior year was 3.31. So we're just going to assume simplistically that they're paying 2.5%. Cool. The funniest thing is Apple is actually a safer credit risk than most countries. So the rate they pay on their debt is insane. It's close to the cash rate, which is interesting stuff. So in the Apple financial model, it's the same thing. When we talked about fixed assets increased by CapEx, decreased by depreciation. That gave you a net written down value. Interest payable is a similar thing. You incur interest expense, you report it through your P&L, and that increases your payable. But then until you pay it, it sits on your balance sheet as a payable, and your closing interest payable balance is basically the interest expense you incurred during the period less what you paid is the movement in your interest payable. Okay, and that basic formula is the T account we're going to build in here. So it's going to impact all three financials. So to start off with, let's put the interest payable balance in. So So we're going to put their interest payable in here as 239 million. So go to their opening balance sheet and go to interest payable. That's a current liability because it's payable within 12 months.
Yep. So interest payable
of 239.
239.
We've proxied that by basically saying, okay, and this again, mass simplification. Like doing proper capital structure analysis is not painful. It's fun, but there's a lot of different facilities, a lot of different terms, a lot of different. Some of the interest might capitalise. There's lots of stuff going on, but this will get your model up and running, and then you get the fun bit where you just keep hacking down. So in this case, we're just assuming that basically 1 month of interest isn't paid at the end of the year, because you basically calculate how much interest you pay at the start of the next month. So of that, we're just assuming, okay, of that 2873 they had during 2020. 1/12 wasn't paid. We've rounded it and said, let's just call it 239. So we'll put that as a payable on the balance sheet, right? So that's disbalanced the balance sheet now because we've now got an interest payable in there, but we haven't got interest expense and interest paid. Okay, so let's fix this. So let's go to the interest expense assumptions. Go to the forecast assumptions. Let's look at how we're forecasting debt interest expense. Again, we're not forecasting by facility. We're not forecasting by different types of commercial versus term debt versus senior debt versus term debt, etc. We're literally just going to say we're not doing a base rate. We're keeping this really simple, but all the fundamentals are the same. So I've built some models that have had 17 debt facilities with 3 or 4 billion of debt in them, and in analysis this is quite simple. But you layer on different base rates and swap rates, then you layer in swaps and hedges and all sorts of stuff. The principles are still the same. How they impact the financials, how you calculate things. It's just layers of complexity. Like there's other things like fees and costs and margins that are amortized, but ultimately it's the same concept. You borrow money, you pay interest, you pay some fees, you repay it. You basically, this is how debt works. It's very similar. It's just there are different laws in term sheets determining who gets paid when and how and why.
Just different mechanics.
Exactly. So we've put for debt, we've put our all-in interest rate in at 2.5%, and we've said, okay, let's assume that 91.67%, which is 11/12, is paid during the period. So that's how we've done that. Okay, so you see that debt drawdowns and repayments are assumed to occur at the end of each period. That's just a simplification here. That means, for example, we can take the opening debt balances, multiply it by the all-in interest rate, and that'll give us our interest expense for each period. You could take the average balance for the period or the ending balance if you like. It really comes down to how complex your model is. And for example, if you've got stable debt balances, it's not going to make a huge difference. In some cases, you can get in trouble with circular references, but with opening balance, you're pretty safe. Okay, so it's really a personal choice based on the model you're building. Okay, so the all-in interest rate for Apples is assumed to be 2.5% in all periods, based on the FY20 proxy implied average interest rate of 2.56. So given that Apple's opening debt balance is 112,436, these assumptions will result in interest expense of 2,811 for FY21, which is interest expense of 112,436 times 2.5%. Now, where it gets complicated is that if you assume that 91.67% or 11/12 of that is paid during the year, then interest paid will actually equal 2,816 because you've got the opening payable balance of 239 plus 11/12 of the 2,811, which the interest payable therefore will be. So the interest payable at the end will be 234, which is the 1/12 of the interest expense.
The 1 month remaining.
Exactly, but your interest paid will actually incorporate the 2,816. Will be 2,816 because it'll incorporate the 11/12 that's actually paid plus the opening balance of the 239.
Yep.
Okay, so that's actually a $5 million decrease from the opening balance sheet interest payable because obviously the debt balance is being paid back. Okay, so if you look at that from a financial statement impacts perspective, you've got interest expense of 2,811, you've got interest paid of the 2,816, which is 11/12 of the 2,811 plus your opening balance of 239, and then the net movement is 5 down, a 5 reduction in interest payable because you had interest payable, you still had interest payable, but you've reduced your amount of interest payable. Okay, so you end up in a position where effectively your interest expense goes through the P&L as an operating expense, and that reduces your total equity, and your interest paid just determines how much of that comes out of cash versus remains payable at the end.
Yep.
So in this case, we actually paid more than the interest expense during the period. We paid 2,816, we incurred 2,811.
And that's due to the difference of the 1 month remaining at the end of FY21 is 234, whereas the previous month hanging over from FY20 was 236. So we actually paid more than the
So our opening balance we had 239. 239. We paid all of that 239.
Yep.
And then we actually had more. We had interest expense of 2,811,
yep,
and we paid 11/12 of that. Meaning the interest paid will be the 239 opening,
yep,
plus 11/12 of the 2,811,
yep,
which is what gives you the 2,816. Okay, so then the remainder is 1/12 of the 2,811, which is the 234.
Yep.
So we've gone from 239 down to 234, and that is, and that reduction is because we've actually paid more than we've incurred during the period. Okay, so and there's the 2811 where we actually paid 2816, and that 5's different. So so it still balances. So it's a 3-statement impact with this when you're doing payable. And that's the important thing to bear in mind. It's kind of like an asset with a 3-statement impact. Fixed assets, say depreciation, capex, in the balance sheet you had fixed assets written down. Here your payable is simply the difference between what you've paid and the interest expense. So in a really simple example, if you started a company and you got interest expense of $120, but you were paying it the next month, at the end of the year you'd have 10 left over. And your payable would be 10, your payable would be 110, and your interest expense would be 120. Okay? So let's put this through the model. So it's pretty tricky stuff because you've got to calculate, because you've got to accommodate that opening balance thing. And that's what we have to do as well with our interest paid. We're going to have to factor that into our formula, which is probably the most complex formula of this course. Okay, so let's go to the income statement and start by adding interest expense. So we're going to go to row 20 on the income statement. And we're putting it right in the middle because we're going to put interest revenue, interest on cash above that, and then we're going to put net interest expense below that when this is done. So let's go to row 20, put interest expense in column B, and we're using the opening balance, right, as the basis for forecasting it. So let's do in the first period, in the first year, that's the opening balance sheet. So equals if, open brackets, J$7 equals 1.
Then we'll take the opening balance of 112,436, lock to the column.
Exactly. So J25. Otherwise, the prior period.
So debt balance there.
Yep. So prior balance sheet closing balance of I-33, balance sheet I-33.
Perfect.
Yep.
Got that.
And then multiply. So that's your close. So if you press enter, that, and then copy that across, you can just see that that's going to give you your prior period closing balance, which is effectively your opening balance. Okay.
Yep, so that all matches.
That's perfect. Cool. So now just multiply that by your all-in interest rate, which is multiplied by forecast J30.
Forecast J30.
Perfect. And did we put a negative? And let's put a negative sign in front. Okay, so let's put a negative in front of it.
So it is an expense.
Yes, exactly. And there you go. That's one of those classic. Because we know it's always supposed to be negative. If it's a cost, we know it's going to be negative.
It's always clear.
Okay, cool. So then let's equate that. So in row 22, let's just include your net profit before tax, make it J18 plus J20.
Got that.
Perfect, and copy it across. Now, balance sheet's still out because we have our interest payable and we have our interest expense. We need our interest payable on the balance sheet, and we need our interest payable on our balance sheet, on our forecast balance sheet, and our interest paid. So let's start off by going to the cash flow statement.
Yep.
So let's go to the cash flow statement and add interest paid. Okay, so to put the interest paid calculation in the cash flow statement, it's a bit of a complex formula purely because we're wedging it all within the cash flow statement. We normally do a lot of this analysis on separate rows and stuff outside the financials, but for this exercise, we're trying to do it really efficiently. So we're doing it. As a result, this formula is going to be a bit tough. Now, what this calculation needs to say is, okay, there's two parts of the interest payment. The first part is the current period's interest expense being paid, the portion of that you're paying during the period. The second part is the actual prior period's leftover interest expense that you didn't pay, which is the interest payable, which you could take off the prior period balance sheet if you wanted to, but we're going to do it by actually calculating it based on the prior period's interest expense. So to start with, let's just include the current period's interest paid from interest expense. So to start that formula, let's do equals, and just multiply the interest expense on the income statement. So equals income statement J20, multiplied by the percentage of that that's paid during the period on the forecast assumptions, which is at 91.67%. So that's the percentage. That's what's paid during this period. Okay. So now what we need to do is add what's paid from the prior period that's left over. So in the first period, that's going to be your opening balance sheet interest payable. Okay. So we need to actually subtract that because that's a negative number. Okay. So what we're going to do is go to that and just do equals, and then you do plus to the end. Plus if period number equals 1. So if J$7 equals 1, then negative and the opening balance sheet. So we're going to 239.
Yes,
that's it there. So the negative of that, all right, and then just I would actually stagger this. So just do comma. Otherwise, put 0 for now, and then close it off and press enter, and that gives you
21,816.
21,816, which is what we said we would have. Okay, so now what we need to do is add the prior period. We need to add the prior period unpaid. So that we've done that for that period there. So that includes both of them. What we now need to do is do it for the subsequent periods.
Yeah.
And this is where it gets a little bit strange. You can do it in the second cell, but I wouldn't. I'd just do it in the first one. So where we've put that 0, go into that 0, and instead take the prior period interest expense.
So the prior period's interest expense from the income statement.
Yeah, which is going to income statement J20. Yep, which is at the moment a blank cell because obviously in the first one it's not active.
So
it's
I-20 in this, because I'm working out of column J.
Yes, and then multiply that by 1 minus the prior period's percentage paid during period.
Okay,
so open brackets multiplied by open brackets, and go to your forecast assumptions.
So
1 minus, and then at 91.7%. But you need to put it in column I again because it's going to drag across. Yes, and then close the brackets on that. Okay, great. Now copy that across. Okay, so
there we go.
There you go. Right. So if you look at that, it's worth actually just load the traverse formula tool on that. So if you look at this here, if you look at that formula, just look at what it's actually doing. So you bring that across. If you click on that, it's just traverse that. So click on that first one. You're just saying if equals the interest expense for this period multiplied by your assumption of that 91.65, and you're saying plus. And then you're saying if J7, which is the row counter, you're taking the prior, you're taking the opening balance and subtracting that, the interest payable balance. Otherwise, you're going the prior period interest expense multiplied by 1 minus the prior period this, which from period 2 onwards will be that number. So if you traverse that in the second period in 2022, you traverse that there, you'll see that the second part of the formula you'll see is now actually taking the prior period's interest expense and the prior period's paid during period.
Absolutely. So that's taking the original 8 1/3% for J20 there, so the 2811 in FY21, that's what's then paid in FY22.
Exactly. Which I mean you could also do by actually taking the prior period's closing interest payable balance, which would be probably simpler but same outcome. Okay. So now we just need to include that in our operating cash and net cash flows from operating activities. Now note that just add plus 21 to that. Now note that our that interest expense is an operating cash flow. This is a really important point. Dividends are a financing cash flow from the perspective, because the financial statements are from the perspective of the common stock holders, the ordinary equity holders. From ordinary equity holders' perspective, interest expense is an operating expense of the business. It's necessary to run their business. It's not a return they get, it's a cost for them. That's why it's an operating expense. So drawdowns on repayments of debt are financing cash flows. They're not considered operating expenses, whereas interest paid is an operating cash flow, and that's really important to bear in mind. Okay. So after doing this, you should have net operating activity should equal 76602.
Yes.
Increasing to 83451. Okay, so after doing that, your net cash flow from operating activity should equal 76602 in FY21 and increase to 83451 in FY25. Okay, good. So that was an ugly formula, but we got it in. Okay, so interest expense and interest paid have now been included. We now need to include the balance sheet interest payable, so the balance sheet balances, right? And that balance sheet interest payable is going to be the unpaid, interest expense at the end of each period. Okay, so let's go to the balance sheet and in 2B of the table of contents, and let's just put in row 28, in B28, let's just put interest payable. And then for J28, the formula here is quite simple. It's a lot like what we did with, for example, assets. Where assets, we added capex and remove depreciation. With this one, we take the prior period and then we add the interest expense and subtract the interest paid. Now, the interest expense is already negative on the income statement, so we're going to effectively subtract that negative interest expense, and then we're just going to add the negative interest paid off the cash flow. Okay, so for the first part, let's just get the prior period interest payable. So equals if open brackets J$7 equals 1, which is if the period number equals 1, then take the opening balance sheet, which is J20, the interest payable balance, J20, dollars J20, and then comma. So otherwise, we just want to take the prior period on the balance sheet, which is I28. Remove that piece. I've just got to the point where I start typing I28 now, but that's just do that. I28 close brackets. Okay, so that, if you press enter on that, just close the bracket and press enter. That's our prior period. That's fine. Okay, so now what we want to do is now we want to add interest expense, which means subtracting interest expense off the income statement because it's a negative number. So negative interest expense, which is income statement J20.
Yep.
So we subtract that, and then we need to then subtract off the interest paid, which, because it's a negative number on the cash flow, is plus cash flow statement J21, which is the interest paid. There, press enter. Okay, and now copy that across. And now we just need to include that in the total current liabilities by changing the formula in J31 to J26 to J28 and copying that across. And our balance sheet balances.
There we go.
Okay, so what we've done here You don't need to model interest payable. It's just most companies probably have it because they don't pay all the interest in the year. So very, very similar to things like assets and working capital, particularly assets. We've got a liability here though that increases as a result of an expense and decreases as a result of a payment. And that expense is interest expense and that payable is interest paid. So now we have, if you look at it now, we now have, I'm just going to show you, we didn't look, when we looked at this through the income statement, you can see we have the interest expense coming through, the interest paid coming through, and the interest payable being the different, that 5 decrease, which we've got here. Now, if you look at how that looks in the financial statements when you have both debt balances and interest balances, you end up with your debt balances being in your balance sheet and your cash flow statement, which was that 3 net decrease of debt. Then you have your interest expense paid and remaining payable across the 3 financials. So when you look at debt, those impacts, and that's a fairly simple debt module. You can have pretty complex stuff where you have sort of some interest being capitalized, which means it moves into outstanding, but it's non-cash. So that type of stuff. So this is basically the foundation of modeling any debt instrument. And you can see it looks pretty ugly looking at that diagram. There's just on that diagram, there's 6, 7 different impacts. But when you break them up into 2 lots of impacts where you've got, or 6 impacts, when you break them up into 2 impacts where you've got the balances impacts, which are pretty clean, balance sheet and cash flow, and then you've got the interest payable balances, which is the expense paid and payable, then it all makes perfect sense. And if it disbalances, you need to look at them as those 2 subsets within the debt analysis. Okay, so now let's look at ordinary equity. Ordinary equity is at the other end of the spectrum from debt, which is obviously, debt is basically secured. It doesn't get any upside in the business, but it's a lot safer, cheaper. It's cheaper. Ordinary equity is basically the lowest ranking form that has the most upside. It's referred to obviously as common stock or shares. Now we've got some commentary in the materials about this. When a company is incorporated, you normally have to have at least 1 share, but you can choose the number of shares you actually issue. Now, you generally also choose the price of the shares during incorporation. So when we started Modano 10, 20 years ago, we just put like $1. I think we put $1 as the value of all the shares. A lot of times people do say 100 shares at $1 a share and put $100 in, and that results in your cash going up the balance sheet, your equity going in, and you have 100 shares at $1 each. Doesn't really matter. You're supposed to represent the value of the business in incorporation, which for most companies is 0. If you do funding, you might actually put it up at higher than that. Okay, so the interesting thing with Apple is that Apple basically, when you issue stock, you put the book value of the stock, which is the issue. So if you issue, say, $1 million worth of stock at 1 million shares at $1, you put that in as book value of $1 million, and that creates equity of $1 million. The interesting thing with Apple is its book value of its shares is like 60 billion, 70 billion. Its market cap is over 2 trillion. So there's been all this appreciation. So when they do buybacks of shares, they're in this weird situation where to buy back 1 share costs them a lot more than the book value. Mm-hmm. So what Apple was doing during 2020, it was doing an enormous share buyback. So it's weird. In a lot of companies, you can buy back shares at close to the book value, and you just buy back the stock, and you don't sit there worrying about the share price or anything like that. So you can say, okay, a reduction of equity of $5 million is $5 million cash out the door when you're buying back shares, which is what we're going to do in this example. In something like Apple's situation, buying back $10 worth of shares at their book value, but buying them back at the market value, which might be 20 times that, would result in a huge reduction of retained profits. Mm-hmm. And if you look at Apple's annual report, it's churning through its annual profits because it actually has a buyback in place. But for the purposes, you can see for Apple, their balance sheet contains under their shareholders' equity the common stock. At the end of, they've actually got an increase in common stock because they're constantly issuing options and shares to staff, for example. It's not that they're raising money. But they're issuing new shares, etc. So the interesting thing with Apple is they have, say, $50 billion worth of common stock, and you see the retained earnings is flying down because they're using a lot of their profits to buy back, and that's due to this enormous buyback they've got going on. But we're going to work through this. So let's start by putting in the ordinary equity with the common stock of Apple, the 50779. Let's go to the opening balance sheet and put in the ordinary equity in, say, J33, 50779. As the ordinary equity value, and you'll see we've still got total equity. We've still got total equity going massively negative here because we haven't put in all the other assets and liabilities, and they've got a truckload of other current assets and other non-current assets and stuff. So because they've got all this cash and marketable security and stuff. So basically what that's done is we'll put the equity on there. You'll see very, very similar to debt. You can look at equity and say, okay, let's look at its balances. Debt has drawdowns. Equity has raisings. Debt has repayments. I should say debt has drawdowns, equity has raisings. Debt and then ordinary equity, you have buybacks whereas debt you actually you repay it.
Mm-hmm.
Okay, so you'll see the terminology is a bit different. The other thing is you have dividends instead of interest, and dividends aren't operating expenses; they're returns on capital to the shareholders, and they're normally expected to say a percentage of NPAT, which is your return, what percentage of your profits you pay out. Now, Apple's an interesting business because they've literally been buying back so many shares that they've literally spent almost everything they've made on shares. And they haven't done dividends as much because, to be honest, at the time it was cheaper and more effective and administratively a lot easier to buy back shares. Dividends are a lot more painful and complicated. They're probably not as tax effective for a lot of people and for the company. So basically what we're forecasting for Apple for its balances is just something hypothetical. It'd be interesting to know what Apple does this year, actually, because obviously the share price has gone up a lot. So they'd probably move more towards paying dividends than buying back stock, potentially. But when you've got this much cash, you've got to get it out somehow. So again, like with debt, we've just assumed, let's put some basic assumptions in for forecasts so we can see how it flows through the model. The ordinary equity return of capital, which is the balances of ordinary equity, raisings and buybacks, are very similar to debt. They're financing cash flows, and you'll see we're forecasting a raising of 100 million, buybacks of 1.1 billion, meaning a net reduction, a net buyback of 100. Now, this is ignoring that huge complexity of Apple, which is that their book value of their shares is X, and their the market value of their shares is Y. We're just keeping it simple because that's a whole new can of worms. It's fun stuff. It's worth researching online, but for most companies we've modelled, you don't have to worry about that as much as Apple. So here, for FY21, these assumptions was Apple's forecast equity reducing by $1 billion from 50,779 to 49,779, which is net raisings of 100, buybacks of 1,100. Now, if you look at how that goes through, it's exactly the same as debt balances, only it's equity. And you'll see the debt equity is obviously an equity part of the balance sheet, whereas debt was a liability. Okay, so it's quite. Other than that, it's classification. The treatment is very, very similar. Debt, ordinary equity balances do not affect the income statement, neither do dividends, which we'll discuss in a moment, while interest expense on debt does. Okay, so let's put these in. So ordinary equity is reported in the equity section of the balance sheet. So let's go first of all and put in the cash flow statement. Let's go to the financing section of the cash flow statement, and down in row 34, let's put ordinary equity raisings in B34. And then ordinary equity buybacks in B35. And exactly as we did with debt, let's just equal the forecast assumption. So the raising is just going to be equal forecast J37, which is our forecast raising of 100 million.
There we go, 37.
And then our ordinary equity buybacks is going to be negative forecast J38 because the assumption is a positive number. And if you get that right, that should come up as a negative, and the total of those should be negative 1 billion. Cool. So you can copy those across. Just need to make sure you include those. We need to include those in the net cash flow from financing activities as well.
Just extend that down.
Just make that J32 to J35. Cool. So we've got basically got buyouts and debt repayments of 4 billion happening, increasing to 8 billion, which is fine because Apple keeps making money the way it is. That's not an issue for it. Okay, so let's go to the balance sheet. Balance sheet's still not balancing because we don't have the equity. We don't have the equity balances in the balance sheet. So let's go into the equity section of the balance sheet, and in row 41, let's put ordinary equity in B41 as the heading. This is a very similar process. This one we're going to take the prior balance. Just like with debt, we're going to take the prior balance, we're going to increase it by raisings, decrease it by buybacks, or just take the net of those, like we've done some that the buybacks and raisings and buybacks. So we need to take the prior period. So the formula here is going to be equals if period number equals 1. So if $7 equals 1, so 7 equals 1, then take the opening balance sheet, ordinary equity balance, which is J33. So dollars J33, which is that 50. Yep, 779.
Perfect.
Otherwise, take I41, which is the prior period on the balance sheet.
Otherwise, take the prior period on the balance sheet. Cool.
Yeah. Otherwise, take that. So I41, just to get rid of the BS stuff. The BS. That's what you mean. I41.
Yep.
Okay, great. And then we need to go do plus. So plus, and just add the sum of your ordinary equity raisings and buybacks on the cash flow statement.
So the sum of 34 and 35.
And that'll be the movement. Okay. And now copy that across, and obviously we need to include that in total equity. So the total equity formula needs to be J41, so total equity plus total ordinary equity plus retained profit. So equals J41 plus J45. And the balance sheet balances again.
Finally.
Okay, so after doing this, your total equity should equal 5142 in FY21, and increase to 207 in FY22. 25.
Mm-hmm.
Okay, so what we've done there with the ordinary equity balances, the big thing to note is exactly the same treatment. They're financing cash flows through the cash flow statement, only they're reported as obviously equity because the owners own that equity, as opposed to a liability that needs to be repaid like debt.
Mm-hmm.
So it's just different classification on the balance sheet. Now, where things get interesting with ordinary equity is with regards to ordinary equity dividends. So ordinary equity dividends are obviously ordinary equity dividends are the obviously return on capital to the shareholders of the business. Now, if you look at the share repurchase program, I've got this on my screen now. This is where it gets interesting. Historically, Apple wasn't paying enormous dividends because it was actually cheaper and easier and more tax effective for it to buy back stock, particularly when the share price was half what it is now.
Mm-hmm.
So if you look at Apple, they've got this program, whereas the company was authorized to purchase up to 225 billion of common stock back, of which they bought back 170 billion. So they'll probably continued this into 21, but because they've just got to get the money out. They've got so much cash. So as a result of that, you look at what they were actually doing, and there was just an enormous number of share. The dividends were around 14 million. The stock repurchased was around 72 billion. So 14 billion and 72 billion. So all of the problem is that stock repurchase. What's amazing about it is the stock was so expensive that the book value of their stock kept going up because the new options they're issuing. So they're buying back stock using billions of dollars, and their stock's still going up, the book value, because the decrease is so small because they're buying it back at like 20, 30 times what the book value, what it was issued at. So this makes modelling this really complicated because when you're buying back, so they repurchased, during FY20, they repurchased $917 million worth of shares, 917 million shares, for 72 billion, implying an average buyback price of $79, which compares to the $2.99 average share price implied by its balance sheet. Ordinary book value of 50 billion and shares outstanding of like 16 what is that, 16 what is that million? So it's 16 billion shares. So 16 billion shares.
Yeah, wow.
So it's insane. The numbers are so big it actually messes with your head.
It's crazy.
But basically there are a lot of reasons why they did that. We don't want to get caught up in this here. So for the purposes of this, what we're going to show you is how to model dividends in a business that works in 99.9% of businesses. And for Apple, it does work if you assume they stop doing this crazy stuff. So what we're assuming is instead of Apple buying back shares and issuing small dividends, instead we're just going to assume they're going to pump up dividends going forward on the basis that maybe the share price has gone up so high they're like, hold the share buyback plan. We're going to actually start paying dividends now because we don't want to buy back shares at 2.5 trillion dollar valuation, which may be the case. We don't know. We'll probably, by the time you watch this, you'll know. Okay, so you look at their statement here. As I was saying, they've got 14 dividends there. What we're going to do is just change this. So we're going to say, okay, dividends declared. We're going to make the presumption that Apple declares dividends at the end of each year before its annual report, and then it repays them, and then it pays them at the start of the next period, right? Which they may well do. So here Apple declared dividends in 2020 of 14 billion, which was a small decrease in the 14 billion 129 from FY19. So we're going to assume that 14,087 million was declared during FY20, but wasn't paid at the end of the year. Okay. Now the dividends payable stuff is with interest payable. You've got interest payable plus interest expense minus interest paid equals your closing interest payable. With dividends payable, very similar, but instead of it increasing with interest expense, it increases with dividends declared. Dividends declared go through the balance sheet, which we'll go through in a moment. They come out of retained profits. They don't come out of the income statements. That's important. Dividends do not affect profit. They come out of profit, so they don't affect the income statement. They affect effectively your equity left in the business because you're taking it out of the equity in the business. Okay, so after activating the balance sheet, let's go to the opening balance sheet and let's enter the dividends declared of 14,087 in cell J21. So the dividends payable. That's 14,087. Balance sheet's gone off again because now we have a dividend declared amount. We don't have dividends declared or dividends paid in the balance sheet. Okay, so now let's go. The next thing we're going to do is we're going to go to the table of contents, go to the forecasts, just have a look down at dividends declared. So dividends declared down there, we're saying 90% of net profit after tax. This is quite simplistic. There are lots of ways you can do this, but in most models we've built, people do it this way when they're doing business planning. If you're doing a really complex capital structure analysis, you might make it a bit more complex, but ultimately companies generally like to pay dividends based on profits. That's the main driver. But sometimes they may actually, for tax reasons, pay dividends even when they're not profitable if they've got franking credits or whatever else. But we're just going to assume that they're going to be pumping cash out through dividends, which is going to increase their forecast dividends relative to their annual report, but we're not doing buybacks, so it is what it is. Okay, so here, For FY21, we're assuming 90% of our net profit after tax is paid as a dividend. NPAT, net profit after tax, is currently forecast to be 66,150. So if the forecast were not to change when the model was complete, which they will a bit, because we're still going to put in tax expense and stuff, but for the time being, if you were going to assume that was the basis, the dividend would be 59,535 for FY1, which is the 66,150 times 90%, and it would remain unpaid at the end of the financial year. So assuming that the FY20 dividend payable amount was paid during that year, you end up in a situation where you'd have 14,087 paid, you declare 59,535, and your movement in your dividends payable would be 45,448 because you already had the 14,087 dividends payable.
Yes.
So at the end of the period, your balance will be 49,555 payable, but your movement will be 45,448 because you've gone from 14,087 to 59,535. Okay, so you'll see that's the relationship. Declaring dividends does not affect NPAT at all. Okay, if anything, the payment of dividend indirectly affects NPAT when you pay them because it reduces your cash, which would impact your income statement via, say, interest revenue. But that, again, it's indirect. Don't worry about it. Okay, so we need to go into our financial statements and record this now. So, as I said, dividends are not reported on the income statement. They come out of retained profit, which is why they're at the bottom of our balance sheet. So if you go to the balance sheet, and remember we build up the retained profits detail, the retained profits is comprised of your opening retained profits plus your net profit after tax during the period minus the dividends, which it sort of implies that come out of that. In this case, there are so many ways you can model dividends. We're just going to keep it simple, and we're going to assume that you wouldn't pay a dividend if net profit after tax is negative, but if it's positive, we're going to assume you'd pay 90% out. So the formula we're going to put into row 44. Just if you haven't done so, obviously you've expanded those rows, so 42 to 44, and in J44 let's put equals negative max, the max function, which takes the maximum of open brackets J43, so the prior period net profit after tax, so J43, so the maximum of that number and 0, so comma 0. So if that's negative, it will return 0.
Yes.
Multiply by, and then go to your forecasts and go to the 90%. That should give you a dividends declared number of 59,535.
Yes.
In that period, copy that across. And you'll see as you copy that across, cool, you'll see that results in dividends being declared increasing from 59,535 up to 63,091. And your retained profits is flying down. That's because obviously we've started with a massively negative retained profits balance because we haven't put our opening balance data in yet. We haven't finished it yet. So it's still not balancing though because we've included our dividends declared. We haven't included our dividends paid or our dividends payable on the balance sheet. Okay, so let's go to the cash flow. Let's go to the cash flow statement.
Yes.
And we're literally just going to say the dividends paid is equal to the prior period dividends declared. Now we don't know what the dividends declared in the first period are the dividends payable on the opening balance sheet. So we're going to use an if statement. So first of all, go to row 36 and in B36 put ordinary equity dividends paid. In B36. Note that it's a financing cash flow. Even though it's a dividend, it's a return on capital, but because it's to the owners of the business, it's not an operating cash flow. It's a financing cash flow. Okay, so the formula here in J36 is if it's the first period. So if J$7 equals 1, then you started doing what I do. You just write it. It's easy.
Yes. Yeah.
J7 equals 1. Then negative. So you want to pay negative the opening balance sheet dividends payable amount. So dividends payable is J21. Yep, 14,087. Otherwise, so comma, you want to pay the prior period's balance sheet interest payable closing balance. So balance sheet I-44.
Balance sheet I-44.
Oh, sorry, the prior period declared.
Declared, yes.
Declared, yes. So just put I-44 because you want to get the prior period. Prior period. So I.
There we go.
Yep. I-44.
Got that.
Yep. Great. Yeah, and that should give you. That should give you a dividend of that should give you 14,087 in the first period.
Yes.
Increasing to 62,655.
Got
last
that.
period.
Perfect.
Okay, and then just update cash flow from financing, net cash flow from financing activities by making it equal to the sum of 32 to 36.
Yes.
Okay, so we should have net increase decreasing cash held of 47,515, decreasing to 1396.
Yes. Yep. 1396 in the final period.
1396 in the final period. Okay, great. So we're still not balancing. Why are we not balancing?
Because we need to get the payables.
Yes, we need dividends payable in the balance sheet. So we've put dividends paid in, we've put dividends declared, we don't have the payable. And the payable in each period is actually equal to the dividend declared for that period. Which, but it is funny. It's not that simple though, obviously, because we need to there's actually a net of dividends declared and dividends paid. Mm-hmm. But in the first period, what we're going to do is we're going to take the prior period dividend payable. We're going to add dividends declared to our payable and subtract dividends paid.
Yes.
Okay, so the first thing we need to do is grab our prior period dividends payable. So go into row 29 and just put on the balance sheet.
Yes.
So go to the balance sheet in 2B of the table of contents, and then go to row 29, and in B29 just put dividends payable. Payable. And then in J29 we're going to do equals if it's the first period, if J$7 equals 1. So if it's the first period, number equals 1, then put the opening balance sheet dividend payable number, which is $J21.
Got that one there.
$J21. Otherwise, the prior period. So otherwise, you want to do the prior period, I29, the prior period balance sheet number. I29.
Got
so
it.
Yeah. So the prior period.
Yep.
Yeah. So I29. So, and then now what we need to do that is we need to add to the end. So we need to now subtract off. So we need to add dividends declared to that. Now, given that dividends declared down in row 44 is a negative number, we need to subtract it because we need to add it.
Yes.
So put minus J44, and that's adding your dividend declared. Now we need to subtract your dividends paid, which the cash flow statement, it's a negative number, so you're adding it because it's negative.
Yes.
So plus cash flow statement J36, bang, and there you go. And that's your dividend payable closing balance, which should also equal. So literally for us, I think in every period, it's pretty much going to equal the dividends declared.
We should do, yeah.
Yeah, it should.
Because what we're declaring, we owe that.
Yeah, so that's a complex way of writing basically equals dividends declared.
Equals negative.
But I mean, at least we understand what it is because we wanted to show that T account.
Yes.
Okay. So let's just include that dividend payable balance in the total liabilities by going to J31 and just adding plus J29 in there, and then copying that across, and our balance sheet's back to life.
Lovely.
Okay, so what we've now got after this total liabilities should be 215,277 in FY21, should equal 214,094 in FY25.
214,094, yes.
214,094, yes. F15. So now you see the balance sheet now contains the balance sheet movements. So it now contains both the movement in the ordinary equity, and it contains the movement in dividends payable from dividends being declared and dividends paid. So if you look at that on my screen, just like debt, the difference is with debt you had interest expense coming through the income statement. Here you've got, and interest expense was going into NPAT, which was effectively coming through retained profits coming out of NPAT. Whereas here it actually goes straight through dividends declared on the balance sheet. It doesn't affect earnings because it comes out of earnings. Mm-hmm. And then our dividends payable is the net of dividends declared and dividends paid, the movement. And then our ordinary equity raisings and repayments, the net of those becomes the movement in ordinary equity. Yes. So again, you've got 6 impacts that are actually 2 lots of 3 impacts that balance in their own right. And if you're modelling that properly, you'd put those balances and you put the balances calculation, the declared calculations and stuff in a chunk of analysis outside of the financial statements, and you just link in those rows, and you'd be able to do those T account balances and those checks as error checks outside of the financial statements. Mm-hmm. So obviously we're just hacking it for the purpose of this exercise.
Yeah, so always coming back to return on and of capital.
Exactly. So the balance sheet now including debt and ordinary equity is now starting to look pretty full. Okay, we've just got corporate tax and other financial statement items to put in there.